Good morning. It's Jeffrey Christian of CPM Group. It's 10 minutes after 11 a.m., the morning of Friday, the 22nd of August here in New York. Fed Chairman Jerome Powell has made his speech at the Kansas City Fed's annual Jackson Hole symposium today, and I'll talk a little bit about that in a second. I want to talk about, I'll run through the markets too. I want to talk about nonsense that I've been picking up about gold in the market. And it's, we have spent several videos in the last several weeks focusing on some of the inaccurate information being spread by silver promoters on silver. And I've wanted to pivot away from that, and the gold promoters have given me an opportunity to do that and to show that it's not just the silver market that's overrun with really inaccurate, nonsensical comments by would-be experts. So I'll go into that first, but let's talk about the markets first. Pretty interesting day. Gold started at 8:40 this morning. London gold was $3,324. The December contract was $3,368. We'd seen a continuation of the sideways move. After Powell's speech at 11 o'clock, 10 minutes ago, gold in London had risen, $51 to $3,375 for spot gold in London, $3,374 in New York for spot London. The $12 premium that had existed between August Comex gold at 8:40 in the morning relative to London had disappeared, and December Comex gold had gone over $3,400 for the first time in several weeks and gotten up to $3,419. So very positive response in the precious metals market to Powell's comments about the imminent arrival of lower interest rates and other factors that he talked about. In silver, we started the morning at $37.81 for the September contract. It was $38.94 at 11 o'clock, so up more than $1 from where it had been in 2 hours and 20 minutes earlier. So you've seen a positive response going up there. In both cases, it's very important. They're still in the ranges that have held really since July. Our expectations, as you guys know, is that the prices will rise further over the next several months and into 2026. This may well mark the beginning of that kind of upward move. Platinum prices and palladium prices also rose. Platinum prices were $1,339 this morning. They're $1,372 after his speech. Our expectation remains that the platinum price will probably continue to decline after the speech is digested. And the same is true with palladium. Palladium went from $1,123 this morning to $1,147. So it also has risen. It probably is not as high as it was 3 days ago on Tuesday when we did the video. I'd have to look. And our expectation is that the price continues to move lower in the weeks ahead for palladium. In terms of Powell's speech, he lived up to the market's expectations. He paid homage to the idea that there will be an imminent rate cut or two, but he reemphasized the risks to the economy, that there's still very potent inflationary pressures abroad in the U.S. economy. Especially, he noted tariffs and the questions of what the tariffs will mean for prices. Said that we're already starting to see some of the upward pressures on prices at the consumer level as well as at the wholesale or industrial level due to the tariffs and the massive increases in government spending that's coming down the pike. Offsetting those inflationary pressures are the negative consequences that are also emerging for business investment and employment. So a warning about rough economic times ahead but a homage to the idea that the Fed will probably be lowering interest rates because it will need to because of the rough economic times. Not very specifically because the president has been asking for it, begging for it, demanding it, throwing a temper tantrum. Now, gold market is overrun with nonsense. It's not just the silver market. And I've been hearing over the last several weeks all sorts of commentaries by people who hold themselves out as experts saying that the market has been drained of 3 million ounces by someone. And there was one guy who actually speculated that it was Warren Buffett. But there's all kinds of stuff. And the reality is that the market has not been drained of 3 million ounces by anyone. You know, these comments display a nearly total lack of knowledge about how futures markets work and the relationship between futures markets and physical markets, and what the delivery process for futures contracts and depository receipts actually is all about. And I know a lot of comments to our videos has been, will you please explain the futures markets? And quite frankly, we've focused on more imminent and immediate issues going on in the precious metals markets in these videos, because at the end of the day, explaining what futures markets are, why they exist, how they interact with the physical markets is coursework. You know, you should go to college and take a course in it. And we're making these videos free for a variety of reasons, a lot of which is to educate the public on the realities of precious metals and commodities markets. But we haven't gotten into it. But I guess maybe we should have. So the gold market's overrun with nonsense. And to understand how wrong these fears are, you have to understand the futures markets. And a lot of people clearly don't. They are esoteric and inconsequential to a lot of people's lives. First off, you have to understand the deliveries are deliveries of contracts representing depository receipts. A futures market contract is a contract between someone who says, I will sell that commodity in that month, and the clearinghouse that makes sure that everybody who's involved in the futures market has the financial wherewithal to live up to their obligations in order to avoid those imaginary defaults of the Comex or the CME that you keep hearing the fearmongers talk about. And on the other side, contracts between people who say, I want to buy that commodity in that given month, and the clearinghouse. So what happens during that active contract month, or during any contract month, is that the shorts will initiate the delivery process. The shorts will go to the clearinghouse and say, I have said that I would sell August gold contracts. Here are my futures contracts. I have depository receipts that I have already given you against my short position. You get to take my contract, go to somebody who's long the August contract and say, here are the depository receipts. You now own that gold in that depository, and you have to put up 100% of the value of that gold today, right? You've got a day to settle. Now, there is a clause in a futures contract, in all futures contracts, that if you get delivered on one day, you can redeliver it the next day without putting up 100% of the dollar value of that contract. And that's very important to understand. So the first thing to understand is these are deliveries of futures contracts representing depository receipts between the shorts and the longs. It's not delivery of physical metal. It's not metal being removed from the depository. Another thing to remember, and I'll show you some data that maybe kind of helps you understand this. It's not one entity doing the delivery, and it's not one day. The deliveries occur, a lot of the deliveries, the majority of the deliveries, half of the deliveries now for August, occur on the first delivery day, or the first 2 delivery days. But it's not one day. They're spread out over the month. And it's a host of companies that are taking delivery and making delivery. It's not one entity. The same way that when the price moves sharply on a spike in volume, it's not one entity. It's hundreds or thousands of entities, many of whom are using computer-driven buy and sell recommendations. And in many cases now, the computers actually do the buying and selling and inform their owners that they've done that for them. It's not one entity. It's not one day. And it's also very important to understand the contracts on gold can be and are delivered over and over again. Much of that first day's deliveries are exactly that. It's taken delivery one day, redelivered the next day, and redelivered over and over again. Now, why do longs do that? Well, a lot of longs are commercial entities. Others are investor groups or groups that sell gold to investors. And they'll mine the depositories. They'll see what gold they get, which brands they get in the delivery process. And if they want that gold for their physical business, they'll pay up and keep it, sell it, deliver it to their customers. If they don't like the brand, they'll redeliver it. There's also some ease in that process in doing it. So the longs have a couple of reasons for doing that. The result is that someone can be long on one day, day one, and become a short on day 2. Hardly sounds like someone who's looking to suppress the prices. Kind of sounds instead like someone doing its business. The fact that the longs do this is further evidence that the longs basically are not interested in taking physical delivery for much of the metal, but rather they're engaged in trading futures and options. They have a physical business, and they have futures and options business. Some of them are primarily futures and options traders and brokers and market makers. Some of them are physical dealers. One of the things that sometimes people run into a problem with is that they think that their futures broker is also involved in the physical market, and they're not. And we've had customers who have come to us with issues because they thought that their physical brokers could deal with them on the future side, and they couldn't. A lot of futures and physical people do both. Not all of them do. And the fact that you have these longs taking delivery and then redelivering the metal or leaving the metal in the depository is indicative of the extent to which they're not interested in taking physical metal, but rather they're engaged in trading futures and options. And there's a very big difference. And you find a lot of people who believe in gold and silver think that those people who trade futures and options, either because of their commercial business, hedging their physical markets, or because they're market makers as a business, or because they're investors, there are a lot of people who think that these people would be buying and selling physical metal if they weren't. They're not. They wouldn't. They're involved in the futures market because the futures market exists. They would not necessarily go to the physical market if the futures market didn't exist. It's another big fallacy that a lot of true believers have. Another factor is these are working depositories. People see the numbers, and the total amount of gold or silver held in these depositories is relatively stable. I'll show you some numbers in a second. But the reality is that metal is flowing into and out of them every day. There are companies that are not involved in the futures market, or maybe they are, But there are companies, refiners, and others who are delivering metal to those depositories. And there are others who are taking metal out, industrial users and others. This chart might surprise some people. Commercial participants in the futures market, merchants for the most part, have long and short positions. You hear a lot of demagogues always talk about the net short position, this massive net short position of 20, 30 million ounces of gold presently in the gold futures market. This is an enormous negative overhang. But that net masks the fact that the commercial entities involved in the futures market have about 40 million ounces of gross shorts and about 20 million ounces of gross longs. And those 20 million ounces of gross longs are very important when you start saying, well, who is it that's taking delivery of the active August contract? A lot of times it's not an investor, it's a commercial. These are those Comex registered depositories: Asahi, Brinks, Delaware Depository, International Depository, Loomis, Melka Almit. These are depository companies. Asahi also has refineries and smelters and commercial business. HSBC, JP Morgan, Manfred Tordella and Brooks, StoneX, those are companies that are involved in the physical market and or the futures markets. And they're all working inventory depositories where metal's coming in and going out on a daily basis. You can sit outside one of them and watch the armored trucks pull up, unload, load, whichever, and leave. These are businesses that are in the business of storing metal for third parties. Now, here are the daily deliveries for the August Comex contract per day so far this month. You can see it started on July 30th, the first delivery notice by the shorts, 15,000 contracts. That's like 1.5 million ounces of gold. Say, okay, I have depository receipts with you. I'm short the August contract. Here are my contracts, Mr. Clearinghouse. I'm delivering 1.5 million ounces. Go, okay? You, the clearinghouse, assign those contracts to longs the next day. The first column is the daily deliveries. This next column is the cumulative over the course of the month. 15,000 contracts on the first day. The next day, 2,000 contracts. And the next day, 2,600 contracts. So in the first 3 days, 2 million ounces worth of gold delivered, gold futures contracts delivered to the clearinghouse. Now, some of those 2,000 on the 31st and 2,600 on the 1st of August actually were redeliveries from the first delivery day. Then it gets down 113 a day, spikes up on the 8th, 3,900 contracts. You know, the 398,000 ounces, a pretty big one. And you can see the cumulative 15,000, 1.5 million ounces in the first day. And by yesterday, it was up to 3.3 million ounces delivered. Those are ounces of futures contracts representing physical metal in those depositories. Okay, those are what's being delivered. Is the metal being delivered? Well, in ownership, yes. Is it coming out of those depositories? No. None of the 3.3 million ounces, well, some of it has, but on balance, it hasn't. If you look at registered inventories at the end of July, they were 21.1 million ounces. Yesterday, they were, the activity date is for the 20th. On the 20th of August, they were 21.3 million ounces. There was an increase of 171.8 thousand ounces over the course of that period of time. Registered stocks, right? There were 3.3 million ounces of those registered stocks delivered, and registered stocks rose 171,000 ounces. Knowing on a net basis that 3.3 million ounces was not being taken out of Comex, was not being taken out of the market. Eligible inventories were 17.5 million ounces at the end of July. They were 17.3 yesterday. There was a 273,000 ounce decline in eligible inventories. 171 of that is stuff that was shifted from eligible to registered so that it could be used to deliver those futures contracts in the August contract. And 100,000 ounces came out, went off to some jeweler or electronics manufacturer, or Trump political official. Now, all of this information is free to the public, to you. You can access it. Here are links at the CME group where you can get daily delivery reports and daily inventory stocks. It's not secret. It's a toolbox and there are tools in it, but those tools are inanimate. Anybody can come up, open the toolbox, and use those tools, but you don't have to. You can live in ignorance if you want. Now, I want to show you this. Let's see, I'm going to try to be technically proficient. This is our monthly precious metals advisory for August, and I want to show you that on page 20, page 11 of a 41-page report. We publish this every month, and this is since 2000. I'm going to put my eyeglasses on so I can read it. Since 2021, monthly deliveries. February 2021, 3.9 million ounces. April, 3.2. June, 2.6. August, 2.6. 3.68 in December. And you can go down the list and you can see that 3.3 million ounces in the August 2025 contract is not something that's outrageously out of line. This is not something to wave your arms in the air and say, oh, somebody is draining the Comex of 3.3 million ounces. This is business as usual in a liquid market. So, no, it's not there. This is not a crisis. The crisis is that there is a cottage industry of people who love to disperse misinformation and try to convince investors to buy gold and silver for the wrong reasons. There are good reasons to buy and invest in gold and silver, but the idea that the Comex is being broken or drained is not one of them. I want to end with another note. We got this comment this week. I had made the comment about one of the economic issues is that you're having construction sites, industrial people, food processors, meat packing companies in Nebraska, agricultural farming operations across the country are having problems because immigrant workers are getting pulled off of those sites, either for deportation or being detained. There's about 60,000 people in detention. The government is declining the opportunity to disclose how many people they've actually deported, but it looks like it's about 500,000 people so far this year. And other people are just afraid to go to work because of ICE raids at workplaces. And I mentioned that last in my Tuesday video, that this is actually one of the factors that the Fed and other groups are looking at that are worried about the economic output in the United States. And this guy said, oh, you meant illegal immigrant workers. No, I didn't. Because some portion of those people are not illegal immigrants. Some of them are, in fact, U.S. citizens who have been in this country, have gone through entered legally, been here for decades, have achieved citizenship, and being deported and detained. Others did not enter legally or illegally. They were born here, grew up here, and have become U.S. citizens and have been U.S. citizens. Some of them were born to U.S. citizens, but they're being scooped up and arrested. And for you to think that only illegal immigrant workers are being detained is to demonstrate a level of ignorance of the world around you that defies acceptance. I'm sorry, but you really have a problem. If you were, the way I phrased it is, if you were a Japanese male in the 1950s and 1960s, and you believed what you wrote, the honorable thing that you would do would be to commit seppuku. The less honorable thing would be to spend some time and find out what the hell is going on in the world around you, in your name. Because there's a lot of bad things going on in the world in your name. Don't put words into my mouth. Put words into your head. Think, read, think some more. It's the best thing you can do this weekend. The second best thing, you can go to our website. You can buy our gold yearbook, our silver yearbook, our platinum yearbook. You saw the level of data that we have in our precious metals advisory. You can use these things to educate yourself so that you know better what gold and silver and platinum group metals markets are doing. And you can send us a note at info@cpmgroup.com and ask us how we can help you. You can also be good to yourself, be good to those around you, try to do something good for the world beyond educating yourself as to what's really going on in the world, because it's a crazy place. That's all I have. Take care of yourself. I'll talk to you next week.